And it's time for Dave McCarthy, who's back in studio in Galway. Dave of McCarthy and Associates Financial Consultants. And Dave, the topic this morning, making financial decisions, the fear factor. First question, well, first of all, you're very welcome. It seems bizarre that I'm at this end and you're at that end, but sure, there you go. That's how these things happen.
How's the suntan out there?
Well, I can tell you, Dave, I'm sweltering, but it's not necessarily because of the suntan. It's because of all the windows on the van. It's, you know what, it is such. I'm sorry that you're not here, Dave, because it's such a fantastic setting, and every time I look out, the crowd is bigger than the last time. And look at wonderful place. Anyone that is doing nothing, bring the kids out, run the legs off them, and they'll sleep well tonight. But listen, first question from one of the listeners has been considering buying gold or US dollars as an investment. Best of luck to them on that. What are your suggestions on this?
In a nutshell, don't. The problem here, Dave, is that once you start to move into things like commodities and currencies, you're going way up the risk scale. There is this perception among some people out there that buying gold is a risk-free investment because it's gold. But it's a commodity like anything else, and it goes up and down in price, and unless you're very in tune with that market, which most people are not, the possibility of getting fleeced is quite high. For example, at the start of the year, gold was trading around somewhere around over $1,800. Now it's around the $1,500 mark. So, I mean, that tells a story in itself.
It does, because so many people, and now I'm not in a position to invest in anything other than the next ESB bill, but so many people said, you know what, with the way that currency, in particular the euro, is so exposed, and even sterling fluctuating, that gold is, excuse the pun, rock solid. Clearly it's not.
Oh, absolutely not. It's a commodity. I mean, I just compare it to, you may as well say you want to buy coffee. I mean, you can buy into any sort of a commodity. There's a market in even things like pork bellies in the States is probably one of the more bizarre ones. And I mean, the same is true about buying currencies. I mean, currencies fluctuate up and down wildly, and if you make money in it, I would say it's by luck rather than by design. So you're on a scale of 1 to 10, 1 being no risk, you're up around the 8 when you start to move into those markets. So the answer is stay away from it.
Well, that sounds like good advice. Now, second question, a person who's self-employed and paid into a personal pension plan for many years says, I'm not making any contributions at the moment as I cannot afford to. What are your suggestions as to what I should do with my pension?
Well, this is actually quite a common problem, because some people have this idea when they're paying into a personal pension plan, it's all focused on the contributions, and obviously with the downturn over the last number of years, unfortunately, a lot of people can't afford the premiums that they've been paying in. But the one area that they're forgetting in terms of reviewing is the fact that they've built up maybe reasonable or substantial funds in their pension over the years. It's just sitting there. And the real issue here is, how is that invested? And it should be reviewed every 5 years, maybe to make changes, move it into something else, because the financial world, as you well know, you're in the media, everything moves at a rate of knots, and the financial world in particular moves at a ferocious speed. So I would just say to anybody with a personal pension plan out there, and this particular listener, it's the key issue here is reviewing how the plan is invested, making changes if necessary, but don't just allow the pension to continue blindly for years and years without making any sort of changes or getting some advice on it.
Yeah, it's a pity, really, isn't it, that somebody would, I know financial again comes back to money can only be divided in so many ways, but it's a pity that somebody stops investing in their pension, because we are going to have a huge problem in the future, aren't we, with the amount of people that are underfunded on pensions and in need of state bailout on this.
Absolutely. I mean, to put it bluntly, the government have continuously over the years made a massive cock-up in relation to pensions and the providing people, I suppose, with the opportunities and incentives that they should have to continue with them. But the one interesting point, Dave, is if you walk out in the street and you ask 10 people, do you have a pension? The first answer you get will obviously be yes or no. And the second thing is, do you know what it's invested in? I could tell you 10 out of 10 will probably say no. Do you know what benefits you get out of it? 10 out of 10 will say no. Do you know when you'll get it? When I'm 65. And that's about the extent of it's.
Do you know what, Dave? It is, yeah, but you are so right. And I'll tell you, you mentioned, those of us in the media probably should be more savvy in this. Our pension man comes in once or twice a year. There is no queue to see him, because nobody even has the curiosity to know how well it's performing. Maybe we're afraid that it's performing so badly we'll have to work until we're 80, but in fact that's not the case. But you're right, people just abdicate and walk away. Anyway, listen, I want to get through one or two more. Another query. I have a sum of money to invest and I'm a conservative investor. What options have I got?
Take the money off deposit and look at a capital guaranteed investment. There's quite a number of them out there which have a variety of different features for periods of between 3 and 5 years. You can find one that suits your circumstances and your needs. But if you leave it on deposit, interest rates are going down. They're going to continue to go down. And 1 year rates, and certainly by the time we get to, I say, early next year, you're going to be looking at below 3%. So leaving money in deposit is something you should only do for convenience. But if you want to look at long-term returns and you don't want to take risks, there are quite a number of capital guaranteed type bonds available.
And that would be over a set period of time, a set number of years.
Correct,
is that it?
and some of them have an income feature, some of them have a deposit feature where you get a portion of it back after a year and maybe the rest of it stays there for 3 or 4 years. But there's quite a variety out there, and a lot of people are not aware of the fact that these type of investments exist. Some people have had bad experiences in the past where they've been put into risk type investments which don't suit them. They've got burnt and they just kind of feel, well, if I leave it on deposit, that's my only alternative. And the answer is it's not.
Well, there you go. Now, last one on this. I am looking to pay, another one, I'm looking to pay into a regular savings plan. That's a great one if you can. Can you make some suggestions for this person?
Yeah, very quickly. It's a surprising the amount of savings actually taking place in Ireland at the moment. It's actually, the rate savings, believe it or not, is quite high. A lot of these are life insurance linked plans. I would suggest that you avoid those. Put it into a regular savings account. You get a rate of about 3.5% over a year, and that's a better way at the moment to look after those monies.
Okay, well, short and sweet. Dave McCarthy, come back. We're here for the afternoon and we'll see how we go. Dave McCarthy of McCarthy and Associates Financial Consultants. Thanks a million for joining us, and we're coming up towards the top of the hour.